Welcome to Infinity Lithium's first webinar. My name is Ryan Parkin and I'm the Managing Director and CEO here at Infinity Lithium. I have with me today Vincent Ledoux-Pedaillies, our European Vice President. Welcome, Vincent.
Thank you, Ryan. So this webinar will be divided into three different parts. We will start by a lithium market update, discussing supply-demand fundamentals, prices and costs. We will then introduce you to our European lithium project, and we will finalize with a Q&A session. And you can send all your questions at any time during the presentation by using the blue button. And I'd like to mention we are very pleased to welcome many companies across the entire lithium-ion battery supply chain, from lithium producers to battery makers, car manufacturers, and others. So let's now start the webinar. A PDF for this presentation will be sent out to all the people who have registered, so you can read this disclaimer later. For a number of years now, we've all been aware of the dramatic impact of global warming on the environment, but there's not much we did about it. Today, our governments are finally realizing we need to act and are setting up strict targets to lower CO2 emissions and are pushing for rapid adoption of electric vehicles. And automakers are launching many new EV models, sometimes completely electrifying their fleet as early as 2019. And Bloomberg is forecasting that after the mid-2030s, we will be selling more EVs than traditional cars. And obviously all those cars are going to need batteries, and the battery is the most important cost component in an electric vehicle. And lithium-ion batteries are proven to be the best technology available today and for the foreseeable future. And lithium-ion battery costs have dropped by 80% since 2010 and are expected to fall further in the future, mostly following large economies of scale. And powered by batteries, lithium demand is set to increase 6 times over the next 10 years, growing at around 20% per year. But the issue today is not on the demand side. Demand is here. The issue is on the supply side, which is under constant pressure to feed this demand growth. We're basically asking supply to grow 5 or 6 times in less than 10 years. But for any commodity, it will be difficult or even impossible, especially knowing that developing a lithium plant is hard and takes a long time. All recent projects or expansions have histories of delays. None of them started on time. So we are starting to see more investment in lithium production, but we're still very far away from being able to multiply supply 5 or 6 times in less than 10 years. And limited investments in lithium projects could create significant shortages down the line. There are many strong supporting factors for the development of electric mobility, such as many governments talking about phasing out traditional cars pretty rapidly, automakers launching many new EV models, battery producers building billion-dollar battery plants similar to the Tesla Gigafactory all across the world, especially in Asia and Europe as well. And finally, customers are growingly attracted to EVs, not just because they're cleaner, but because they finally look good, they offer a better driving range, and they will soon be competing with traditional cars in terms of cost of ownership. As I mentioned earlier, Bloomberg is forecasting that by the mid-2030s, we will be selling more EVs than traditional cars. Historically, the main end use for lithium has been in what we call industrial application. That includes usage in glass and ceramics, grease, synthetic rubber, pharmaceutical. However, it has changed recently, led by lithium usage in batteries. So in recent years, lithium has been increasingly used in battery used in portable devices. That will be your computer, your mobile phone, but also power tools, cameras, etc. And now lithium demand is mostly used in what we call electric mobility, which includes electric cars, of course, but also electric buses, e-bikes, e-scooters, and everything which moves around really. So total lithium demand is expected to grow around 20% per year during the next 10 years, the size of the market being multiplied by at least 6 during this period. And battery applications are of course responsible for most of this growth, moving from less than half of the consumption back in 2017 to more than 90% of all demand in 10 years' time. And this is mostly led by full EVs as opposed to hybrids because they have a much larger battery pack, and the size of this battery pack is also increasing. The lithium-ion battery market was only around 2 gigawatt-hour back in 2000, and in 2017 it was estimated at more than 130 gigawatt-hour, a growth mostly led by demand in portable devices. From 2017 to 2030, growth rates will be led by demand in electric vehicles, but also by demand in what we call energy storage systems, which are showing a very strong growth for off-grid residential and commercial demands. Energy storage systems help to smooth out power fluctuation of weather-driven renewable sources, such as solar and wind, therefore preventing the disruptions to transmission grids. In order to be able to feed demands, battery manufacturers are building giant plants, or called gigafactories. Companies like Benchmark Minerals actually track the number of gigafactories being built across the world. And really far the days when only Tesla was building a gigafactory in Nevada, now Benchmark is tracking more than 45 megafactories across the world, expected to reach more than 1,000 gigawatt-hour capacity by 2028. This continued growth will not only be seen in Asia, the traditional dominant player for lithium-ion battery factories, but also in Europe. And really building those large battery plants will allow to keep battery costs declining thanks to large economies of scale and improvement of the manufacturing process. Battery cost already went from around $1,000 per kilowatt hour back in 2010 to around $200 per kilowatt hour today, so which is a drop of around 80%. And again, this will decline further in the future, making EVs more cost competitive than traditional cars. Inside those batteries, there are battery cells, and within those cells, we have four main battery components: the cathode, the anodes, the electrolyte, and the separator. And the most important part is the cathodes. It's the most expensive component, and it is where a number of critical metals, such as lithium, but also cobalt and nickel, are going to be used. And there are a number of different cathode technologies used in different applications depending on their specifications. But the most popular type of cathodes for electric mobility application is going to be NMC, nickel, manganese, cobalt. And the NMC technology is evolving for two main reasons. Cathode producers want to move away from using cobalt, and they want to increase the energy density of the battery. And you can do both of that by using more nickel. So cathodes are becoming more nickel-rich, and this is leading to a shift in product requirements because those nickel-rich cathodes need lithium hydroxide and not lithium carbonate. So lithium hydroxide is forecast to take over lithium carbonate by the mid-2020s, growing around 40% per year during the next 10 years, as opposed to 20% per year for carbonate. And lithium players understand that demand is changing, and therefore a majority of the recent expansion announcements or new projects have been targeting lithium hydroxide as opposed to carbonate. The other thing you need to consider is production costs. Lithium hydroxide is growingly produced from hard rock, which is a straight conversion process, as opposed to brine, which first need to produce carbonate and then convert it to hydroxide, which is adding a conversion cost. According to McKinsey, a fully integrated hard rock producer will have an OPEX around 16% lower than a brine producer for lithium hydroxide. A number of brine producers such as SQM or Albemarle are increasingly investing in fully integrated hard rock projects, as we've seen very recently with Albemarle investing in mineral resources in Australia. The future will likely be carbonate based for brine and hydroxide base for rock. So rock supply from Australia and also from Canada or Europe will enjoy a stronger growth. And staying on the cost side, Orocobre and their analyst Tara Berry have published a very good cost curve a few weeks ago for lithium hydroxide specifically. This really highlights the difference between integrated converters at the bottom of the cost curve, who will have their own hard rock mine and conversion plants. Then we have brine producers who have been impacted recently by new royalties and export taxes, but who also need to add a conversion cost to produce lithium hydroxide. And finally, at the top of the cost curve, non-integrated converters who have to buy the spodumene in the merchant market and therefore have a very high feedstock cost. We believe the future will be led by fully integrated hard rock players producing lithium hydroxide. And rock supply is preferred not just because it's cheaper to produce hydroxide, but also because it's faster to bring on stream than a plant based on brine. Rock resources are also mostly located in countries which are safe and mining friendly, like Australia, Canada, or Spain. It's estimated that hard rock mining capacity will continue to increase its market share in the future, but the main issue with rock production is that it's not efficiently converted into lithium chemicals, and that is because there is a lack of integration. Only two companies are both mining spodumene and converting it into lithium chemicals, but none of them are located in the same country, with rock produced in Australia and lithium chemicals in China. Other rock miners sell the product to a third-party Chinese converter, but some converters are sometimes not ready to convert all the spodumene they are sourcing, and they just don't have the installed capacity ready for the conversion process. Not all converters are equal, and some of them have very limited experience and can be financially unstable. And in the future, more conversion will take place in Australia, with a number of producers like Chenchi, Albemarle, or Kidman planning to build lithium conversion plants domestically. And I think it's crucial to develop integrated conversion facilities in order to improve your OpEx and your margins, but also this integration trend will limit the dominance of China in the lithium chain. And this graph shows you a very clear message. The lithium-ion battery supply chain is largely dominated by China today and in the future, if we exclude lithium feedstock production. More than 50% of lithium chemicals takes place in China. They dominate cathode and battery production and of course electric car production as well. And I said they don't dominate feedstock production because they don't produce much lithium from hard rock or brine, but they control a lot of its output outside China because they've been securing a lot of offtake agreements recently. Chinese companies have been investing in foreign lithium assets for a number of years. The biggest investment was when Tianqi secured 51% in Talison Lithium back in 2013. And since then, Chinese companies have kept investing and securing offtake agreements, mostly in Australia and in South America. And in 2016, with a surge in prices, more activity took place, but nothing compared to what happened in 2017, when many Chinese companies have invested in a number of assets and secured many offtake agreements. Actually, two-thirds of all offtake agreements concluded in 2017 were negotiated by Chinese companies. And with downstream users getting nervous they won't have enough lithium in the next few years, offtake agreements have been the preferred option for buyers to secure parts of all future production of a lithium miner. And it's not just cathode or battery producers securing offtakes, but also people further downstream. This represents the key agreements and investments in the lithium-ion battery supply chain so far in 2018. And overall, the supply chain for batteries remain pretty fragmented. So automakers remain automakers, battery makers remain battery makers, and miners remain miners. And if you look at the relationship between battery makers and automakers, there are mostly basic supply deals, like KTL will agree to supply a certain number of batteries to Volkswagen, but that's pretty much it. But we see more integration between battery makers and miners. We see direct investments, we see joint ventures, and we also see sometimes battery makers completely overtaking some miners to make sure they have enough lithium going in their batteries. And we've also seen recently companies like BMW or Tesla securing offtake agreements directly with lithium suppliers to make sure they've got enough lithium going in their batteries and in their cars in the future. And there are many offtake deals that have been concluded over the last couple of years, and offtake agreements allow to de-risk the supplier's project as they are able to sell future production. But it also allows the buyer to secure volume in a potential tight future market. You can see here that most of the off-takers are Chinese companies and are a mix of existing lithium converters, battery manufacturers, automakers, and also traders. But more recently, Japanese and South Korean players have been more active and have concluded a number of offtakes during the last couple of months. All those offtakes shows us that there is a need to secure supply to be able to feed upcoming demands, but there are very different views on what the supply will look like in the future. And 2018 has been a bit of a strange year with a lack of clarity and understanding. Earlier this year, a number of banks have released reports calling the lithium market long, and it's partly why a lot of lithium company stocks went down.
Those banks anticipated very large volume of supply coming on stream in a very short amount of time. But you don't need to look very far down the line to realize that this is very unlikely to happen. So far in 2018, many supply issues have emerged, illustrating the fact that lithium production is not straightforward. For example, in South America, SQM has delayed their expansion plan, and they will be producing less lithium this year than last year and than in 2016. Chile rejected Albemarle's increase of production quotas. There are a number of issues with water rights, which will limit the amount of lithium that can be produced out of Chile. And overall, we don't anticipate production of lithium chemical to increase this year in South America compared to last year. And that's in a market where demand is increasing at more than 20% per year. In Australia, we've seen more spodumene being produced and exported to China, that's for sure. But that doesn't mean we've seen a massive increase in lithium chemical production in China, where all the spodumene is being converted. There has been a number of delays in conversion plants expansion. Some plants have been closed as well for environmental inspection. And by the end of the year, supply is able to meet demand this year because the market is still pretty small. But what's going to happen when the market is 5 or 6 times this size? And we've seen it in the past, bringing a lithium plant on stream is complicated and takes a long time. On average, it takes around 7 to 10 years to bring a lithium brine production site on stream, but it is faster to bring a lithium rock mine to production overall. You can see that it takes between 3 to 6 years for a rock site integrated into lithium chemical production. But overall, there's always a big gap between announcement of new capacity and actual production of lithium chemical. And when you look at the numbers, you realize that there is always a big gap between expectation and reality. Back in 2012, industry observers expected that by 2017, so in 5 years' time, supply will increase to more than 400,000 tons with a mix of expansion and new projects. However, by 2017, supply was almost half of what was expected. Now, if you look at how slow the ramp-up is for greenfield projects, you realize that new lithium supply will take a long time to reach markets. On average, 8% operating rate the first year, 23% the second year, and only 30% the third year. So it is a very slow ramp-up process. If you look at the different supply forecasts published by consulting companies, research companies, and banks, on average, we foresee production at around 800,000 tons by 2025. On the demand side, it is actually closer to 900,000 tons, but demand numbers are being revised over time, with people becoming more and more optimistic about electric vehicles, but also energy storage systems. So this number is likely to be very different in a month's time, in 6 months' time, or in a year, and that will be different with a higher number, of course. And overall, it will be very difficult for lithium producers to supply the right grade of lithium and sufficient volume to battery manufacturers. And there has been a lack of clarity on the price side too. Many price reporting agencies have communicated on lithium Chinese spot prices falling this year, and this has led a number of people to think the market was oversupplied. However, spot prices do not represent the market. Most lithium volume are medium and long-term contracts, and Chinese spot volume is really a fraction of the global market. Lithium contract prices have increased during the year and are now holding up, and price erosion is likely, but contract prices will not be as volatile as spot prices in China. And a number of analyses and reports on lithium are comparing lithium to other commodities, which can lead to the wrong interpretation. Lithium is not a commodity, it's a specialty chemical. Lithium is split into different chemical products with different grade and specification. And really the number one priority for a battery or cathode producer buying a specific lithium product is the consistency of the product specification. And not all producers are able and will be able to produce battery grade product. And really the relationship between a lithium producer and a lithium buyer for battery grade product is more of a long-term collaboration than a basic buyer to seller relationship, because lithium hydroxide battery grade is an advanced product and highly technical. So this collaboration is extremely important. And before we move to the next part of our webinar, we would like to tell you a bit more about Europe. And from manufacturing EVs to packing lithium-ion batteries and producing cells and battery components, China has been crushing the rest of the world during the last few years. However, Europe is finally joining the race to take second place behind China. And no matter which forecast you're looking at, consulting companies and data providers are all predicting a tremendous growth for EVs, with China leading the way and Europe in second position. In McKinsey's base case scenario, EV production will reach around 26 million by 2030, with China in first position and Europe in second position. Bloomberg anticipates that EV sales will be around 30 million by 2030, again with China leading the way and Europe in second position. And Platts actually estimates that Europe will have a deeper penetration rate for EVs than in China. Again, no matter which production forecast you trust, the reality is that market participants are all seeing a strong EV production and sales in the future, and Europe is one of the key drivers behind it. And obviously, all those EVs are going to need batteries. Now, on the battery side, there's a wave of investments in lithium-ion battery factories across the region, and Europe is expected to be, in the future, the second largest battery producer in the world, again after China. And in Europe, it seems that most of the investments in new battery capacity have been made by Asian-based companies such as Samsung, LG Chem, or SK Innovation. However, some Western companies such as Northvolt, but also Tesla, are looking at Europe to build gigafactories. And just to highlight the fact there's a lot happening in Europe, there's a summary here of the main news around the lithium-ion battery supply chain in Europe only for the month of November. And the EU and governmental organizations really want to develop Europe as a key region for the production of batteries, EVs, but also a fully integrated lithium-ion battery supply chain, everything from raw materials all the way to producing electric vehicles. So a large majority of the battery components today and the battery cells are imported from Asia, but a number of countries are really pushing to invest more upstream to really have a truly fully integrated lithium-ion battery production. And Germany is really leading the way in terms of effort to develop a fully integrated lithium-ion battery supply chain. Not so long ago, Angela Merkel mentioned that Europe should have its own battery cell production instead of importing everything from Asia. The German economy minister is also pushing to have more than 30% of all global demand for batteries being produced in Europe. And overall, this is backed up by automakers and battery manufacturers investing a lot of money in Germany to develop not just EVs, but also batteries and battery components in Europe and in Germany. Now, another step up the supply chain would be to invest in cathode materials where lithium, but also nickel and cobalt are going to be consumed. And Europe is also starting to move towards building its own cathodes and other battery components, with companies such as Umicore, BASF, and Johnson Matthey announcing plans to support this strategy and to build cathode plants in Europe around 2021-2022. So we're going to be strong on the EV side. Battery and cathode manufacturing is developing. The last step of the supply chain is in battery metals. So what do we have in Europe? Most of the cobalt is mined in the DRC and converted in China. Most of the nickel is mined in Indonesia, the Philippines, or Canada, and there's no lithium production in Europe. I think it's important to de-risk the European supply chain by having more domestic sources of raw materials, including lithium. And thanks to its rock resources, Europe is able to produce battery-grade lithium hydroxide at low cost with our project in Spain, for instance. And just before we move on to the next part of the webinar, I just wanted to highlight what the European market for lithium will look like if we have a fully integrated lithium and battery supply chain in Europe. So you can see on the far left the European electric car production forecast to 2030. The next graph on the right will be the equivalent in terms of battery production needed in Europe to feed this demand for electric vehicle. And then the next graph in yellow will be the equivalent lithium consumption in those batteries. So basically by 2030, we will need around 250,000 tons of lithium carbonate equivalent to be fed into those batteries for those batteries to go in those cars. and more than 250,000 tons represents more than 16 times the size of our project in San Jose. So we're only really scratching the surface here. And just as a quick note, the lithium demand in Europe will likely be mostly lithium hydroxide as opposed to carbonate, because the cathode manufacturers in Europe are going to be producing nickel-rich cathode technology requiring very low amount of impurities in those batteries. So let's now talk about our project in Spain, and Ryan Parkin, CEO of Infinity Lithium, will now take over.
Thanks for the update, Vincent. Infinity Lithium's San Jose project is a low-cost, long-life project located some 2.5 hours west of Madrid. San Jose is a fully integrated project whereby its hard rock resource adjoins a proposed downstream processing facility with the ability to produce up to 15,000 tonnes per annum of lithium chemicals. Infinity has adapted to the rapid evolution in cathode technologies with the recent delivery of the lithium hydroxide scoping study. San Jose has more than 1.6 million tonnes of lithium carbonate equivalent, and this represents the second largest JORC resource in the EU, totaling 111 million tonnes. The project is located in the proactive mining region of Extremadura. It is a brownfield tin project with lithium carbonate feasibility study work completed in the early 1990s. The Long Life project sees 16 years of mining activity and 24 years of lithium chemical production, with an open pit and strip ratio of less than 1.2 to 1, providing clear economic benefits. The fully integrated operation has been planned with the lithium chemicals plant located in an adjoining tenement area. There are no royalties payable on mining activities, nor are there tax or tariff leakages that are currently applied through non-integrated Chinese converters. The benefits of immaterial transport costs to the plant was made possible through the 2007 completion of a gas pipeline adjacent to the project area, enabling the sulfate roast process to be undertaken on site. The aerial image of the project area seen here clearly highlights the close proximity of the gas pipeline and footprint of the pit design as delivered under the announced scoping study. Furthermore, geotechnical work completed earlier this year saw a revision of the JORC resource to in excess of 111 million tonnes, and the reclassification of material to the indicated category. As seen in the pit design, more than 90% of the material under the scoping study was in the indicated category. This is represented by the lime green graphics against the drill pattern in the images adjoining the aerial view. As Vincent has covered in some detail, hard rock lithium projects benefit through advantageous process flow sheets whereby lithium hydroxide can be produced without the need to produce carbonate. Infinity has proposed a process whereby a potassium sulfate roast and environmentally responsible water leach is undertaken, bearing similarities to the pathway undertaken by spodumene converters. It is at the lithium sulfate production stage of the process that Infinity can deviate in the production of battery-grade lithium chemicals. Again, the recently announced lithium hydroxide scoping study highlights the economic advantages of the hard rock resource and delivery of lithium chemicals in a rapidly evolving market. With this in mind, Infinity's scoping study delivered a C1 cost at the lower end of the cost curve, benefiting from a fully integrated project located in the strategically important European segment. It is also worth noting that with a C1 cost of close to US $5,340 a tonne over the 24 years of production, the advantageous tax and royalty environment sees a C3 cost further down the cost curve in the context of the broader market. The economic outcomes of the scoping study saw an exceptional base case NPV of close to US $720 million, with an IRR of 51%. The conservative pricing assumptions over the life of the project still delivered robust margins, with the low C1 cost previously noted, and with upfront capex of US $288 million considered over the initial 3 years of the project, the San Jose project delivers an NPV in excess of US $1 billion under a long-term pricing scenario in line with existing market conditions. San Jose is a multi-decade project with the ability to provide further scale when considering the size of the available resource. The Extremadura region is one of many contrasts. However, it is a region steeped in mining history. The region is proactive in the assessment of up to 230 new mining projects, including gold, nickel, and lithium. Furthermore, recent regional support of the La Perilla tungsten project included a €5.3 million grant from the Junta of Extremadura, otherwise known as the regional government. Extremadura currently has one of the lowest GDPs in Europe, with the local population experiencing a significant risk of poverty. It has recently been reported that almost half of the 1 million plus people in the region live off approximately €700 a month. The San Jose project can benefit from significant EU support through tax relief and potentially EIB funding should lithium make the critical raw materials list. Recent acknowledgement of the critical importance of lithium and the broader lithium-ion battery industry would suggest its inclusion being considered. The San Jose project provides the people of Extremadura employment opportunities across project development, construction, mining activities, and processing operations. Furthermore, the VAT derived from the project is retained by the regional government and can provide a much-needed boost to revenue in the region. The Western Australia government has seized on the opportunities lithium has provided and the potential to build supporting industry around the natural resources. Other hard rock players in the market are developing integrated models to deliver lithium hydroxide, and with the strategic importance of San Jose in Europe addressing the current concentration of graphical converter risk in China, the regional government of Extremadura also has expressed their interest to attract supporting industry to a lithium chemicals project. Infinity Lithium is listed on the ASX and has recently announced supporting listings on the Frankfurt and Stuttgart exchanges. Recent changes to board and management has included battery metals expert Vincent Ledoux-Pedaillies, and he has been appointed as Vice President of European Corporate Strategy and Business Development, highlighting the company's continued focus on European markets in line with the proximity of the project. Infinity represents value in the broader market in light of the robust lithium hydroxide scoping study, and further progression of project ownership could see significant upside. Thank you for attending Infinity's first webinar for the San Jose project, and Vincent and I are happy to answer any questions that come through.
Thank you, Ryan. We are now going to open our Q&A session. You can still send your questions now. We've been getting quite a few already during the presentation. So we have a mix of questions really between the markets and the projects. So let's start with maybe a market-related question about prices. And the question is, what is your long-term outlook for prices? And I think I'll probably take this one. Our outlook for lithium prices is pretty strong, especially for lithium hydroxide on a contract base. And there are a lot of reasons for that. First of all, lithium hydroxide growth is going to be faster than carbonate, again supported by cathode technologies moving to high nickel content and therefore requiring lithium hydroxide as opposed to carbonate. So we believe that lithium hydroxide is likely to maintain a premium compared to carbonate. And lithium hydroxide contracts are going to be set as long-term contracts. If you look at the existing and the upcoming producers, they are going to be looking for multi-year deals, so 3 to 5 years, let's say. And cathode manufacturers will also be looking at security of supply with long-term agreements. Again, it's really important to understand that it's more about creating a strong relationship and collaboration between suppliers and buyers, because again, lithium hydroxide specifications are highly technical. Contract prices are going to be way less volatile than spot prices and what we've seen recently. I think the other thing we need to consider is that the new supply ramp-up will take time, and as you know, all recent projects or expansion plans have been delayed, and not just for brine production in South America, but also for conversion plants in China. There's always a massive gap between what's anticipated to come on stream and what actually comes on stream. Operating rates increase are extremely slow, as we've seen it during the presentation, and I think people are starting to understand that and are less optimistic about their supply forecast. And I think the last point is that we really want to supply the European market, which is likely to have a premium compared to Asia. In Europe, the battery-grade lithium hydroxide demands will be coming from companies like Umicore, BASF, or Johnson Matthey, and they will all be producing nickel-rich cathode, therefore requiring the highest level of purity. And I think that maybe one more thing is that the European region will be less competitive than Asia, with less suppliers present in the market. So if you look at the numbers we've put in the scoping study, our forecast for lithium hydroxide is very conservative in the high $14,000 per ton of lithium hydroxide, which is a significant discount compared to today's price level.
Okay, so we're going to move to the next question, probably for Ryan. What does the deviation towards lithium hydroxide means for Infinity?
So, first of all, I'd like to say that we're really pleased to be able to adapt and evolve to an ever-changing market. And this is in direct response to evolving battery technologies driven by the demands of cathode producers. What I would say moving forward is the outcomes of our hydroxide scoping study allow us to engage with strategic partners potentially and also move towards offtake.
Thank you, Ryan. We will probably now select another market-related question, and we've got something coming. What is your view on the future of hard rock versus brine? I think we mentioned a bit about that during the presentation, and I think operating a brine is hard, technically, logistically, and humanly. I think it's difficult to get the product to the right grade. We often compare brine to a living organism. The amount of impurities is always changing, and therefore it's quite hard to get a consistent product out of a brine operation, which is what a battery producer is asking for. And if you look at what has been happening recently in South America, in Chile and Argentina, it's just difficult to operate there. Of course, you've got the royalties that have been implemented recently in Chile, the export taxes in Argentina, the water rights issues, and overall, I think, especially in Chile, the government is getting too involved in lithium. When you look at hard rock, it is simpler to develop a project on the hard rock side. It takes less time. And also those projects and existing mines are located in countries which are low risk. I mean, if you look at Australia or Canada or Spain, it's not as high as an investment risk compared to South America. And of course, we've talked about the argument of lithium hydroxide being cheaper to be produced from a fully integrated hard rock operation compared to brine. So if you look at the recent news around brine producers investing more in hard rock with SQM and Kidman in Australia, and more recently Albemarle investing in a 50-50 JV with Mineral Resources, Wodgina, it's really a sign that some of those brine producers are moving away from South America and from brine and are investing more in hard rock. And I've already said it, but I think the future will likely to be fully integrated hard rock players integrated into lithium hydroxide production, which is really what our model in Spain is.
So we are now going to move to our probably next and last question for this webinar, and probably directed to Ryan. Where do you see the future of Infinity? Is it mostly in Europe, or are you also looking at other regions?
Well, I see naturally Infinity fits well with the European story, and of course we'd like to be included in the European mindset. There are some natural opportunities there, as Vincent has touched on throughout the webinar, in terms of potential cathode producers and OEMs in Europe. We also hold a natural advantage for Southeast Asian players, including those cathode producers in Japan and South Korea, who are currently exposed to significant Chinese converter risk. So all up, I'd say for Infinity and the San Jose project, we have plenty of opportunities, be it in the Southeast Asian markets or the European segment. Okay, well, thank you to Vincent, and thank you to all for making our very first webinar here with Infinity Lithium. I hope you enjoyed the update, both on the broader market and a little on our project in San Jose, and we'd hope to do another one soon. Thanks again, and enjoy your Christmas break.